welcome to our special episode of Investor's Guide. Given the fact that this week we celebrated International Women's Day, today we're dedicating this entire show to our women viewers, women who are watching at home who invest your money. Remember, on this show we put our women investors on top priority. So if you have any question at all you have to do is get in touch with us. Our email ID is at the bottom of your screen. To answer the questions through the entire half hour is Narendra Kumar, the CEO of Value Research, who joins me on the show right now. Narendra, thank you so much for joining us on this special episode.
Thank you.
But before we get into answering our questions, we must, of course, talk about the one big move that happened this week. Over Budget Week, we were all concerned about the fact that the EPF, which is our Employee Provident Fund, might have been taxed because that was a proposal that came in during the budget speech. Now, this week, we saw the finance minister decide to roll that back and no longer tax our withdrawals on our EPF. But the NPS continues to be taxed at a 60-40. So what used to be the case earlier with the NPS is your entire maturity corpus would have been taxed. Now, 40% of it is tax-free. 60% of it will be taxed on the interest unless you invest it in an annuity. Narendra, this puts central government employees at a tremendous disadvantage, doesn't it?
No, not really. Central government employees are getting treated very differently in the NPS. So, NPS for general public has improved quite a bit. NPS, by the design of NPS, 40% of your money is supposed to get into annuity anyway. Now, the remaining 60% was entirely taxable if you wanted to withdraw on your retirement. Now, of that 60%, two-thirds of it, 40%, you can withdraw it completely tax-free. So, in that sense, it is an improvement for NPS. But I would argue that, why this inconsistent thing? If you have a private sector employee whose mandatory deduction is getting into EPFO and all his one is that, his 1.5 lakh rupee contribution under ATC is tax sheltered. It is not charged, it is not added to your income. The return on your investment is tax-free. It is accumulating at whatever rate the EPFO yields. And then when you withdraw it when you retire, the entire thing is tax-free. Compared to that, somebody who voluntarily chooses to invest in NPS, his money, the first two parts are tax-free. But when he's forced to buy into annuity, which I think is wrong. Because the finance minister, all the things that he said in Parliament, that there was concerns about the ability, or savers need choice, and they will have some other plan and they would like to do things themselves. Does it not apply to NPS? That's my first question. And the other is that even if assuming that this law was not reversed. Assuming it was implemented, still I think that there is a reason or there is a case for providing investors a choice.
Now, for those of our viewers who have been using the NPS or the National Pension System in a voluntary manner and investing for that there's also that added 50,000 rupee deduction that we get over and above ATC for our NPS. Do you recommend we continue using the NPS?
Yes, absolutely. Given that NPS has improved. And who knows, things can improve much more, because I don't think this inconsistency can continue, can carry on. And that part, I think, if NPS rules are, or PFRDA rules for NPS, changes in terms of liberal withdrawal mechanism, not necessarily annuity. So, it requires very simple tweaking. That part, the charm of NPS is that you are getting a control on how your money is getting managed. It remains the cheapest fund management available, and I'm confident that for a regular investor over a period of time, on any long-term period, 5 years and more, even with a 50% allocation to equity, no more than 50% allocation to equity, it will translate into substantial bonanza. NPS is relatively young, and it will take for it to demonstrate. It will take at least one bull run for it to demonstrate what the difference is, because right now the difference does not look very substantial.
Continue to use the NPS in a voluntary manner, and of course remember your EPF or your Employee Provident Fund now remains tax-free. That's good news for those of us in the private sector. All right, let's move on now to our portfolio question. Our first question comes in from 32-year-old Anu Kundar Narendra. She wrote in on our Facebook page. She tells us she wants to plan for her child's education and for her own retirement, although she hasn't told us how much time she has on her hands. She sent us her financial details. She has, as an investment, bought a 2-bedroom flat in Navi Mumbai. Combined with her husband, there's a total income of 1.7 lakh rupees coming in every month. Now, 43,000 goes towards an EMI, and apart from that, her expenses of close to 80,000 rupees. Now, she wants to begin by investing, she says, about 50,000 rupees in equity, and she has 15,000 rupees going into a recurring deposit every month. Now, let's start off by looking at the fact that she's not mentioned any sort of life insurance, she's not mentioned health insurance, and there is that RD that can possibly be treated like an emergency fund. But should she step back a little bit and relook at how she's planning her investments altogether?
Yes, absolutely. Without a holistic plan, things don't fit together, and everything has to be customized. And we can lay out the basic principles to be followed. Having the essential money in the emergency, your emergency fund, and you'd specify it. Maybe a part of your recurring deposit could be that. But reconsider, how much emergency fund you should have. Your situation should guide that. You must have the life insurance and health insurance. If you maybe if you have accumulated substantial assets, then you don't need the life insurance. Most people think that you must have the life insurance, but till you have dependents, till you have or if you have accumulated enough savings. Life insurance should be looked upon as an expense, as buying peace for your family till your assets accumulate to take care of them. So that is, don't look at it as an investment. Don't combine it with investment. Look at it as only as buying protection for your family.
This is how we want you to start off. You have to have an emergency or a contingency fund, which is 6 months of expenses, which is in a bank account. So look at your RD that you're putting aside right now. Look at that as your emergency fund. You must have health insurance for the entire family, as high as you can take it. And you must have life insurance for both yourself and your husband, considering both of you are, earning, and your money needs to go towards EMIs, it needs to go towards expenses, and then we start planning your investments. Narendra, she tells us she's 32, which means I'm going to assume at least, a 25-year horizon on these investments. 50,000 rupees going into equity for the long term every month. Which of our portfolios would you recommend for them as a unit?
Goals are quite far off, and for any goal 10 years away. And given that, one has been able to build all the safety nets, just go with that aggressive growth portfolio and be regular with it, And the other thing which somebody in this age should be thinking is keep increasing your contribution to this portfolio with your rising income.
Narendra, our next question comes in from Uma Srivastav, who's on the phone line from Hyderabad. Uma, happy Women's Day to you. Tell us what your question is.
I have invested in stocks, and I have always also invested in mutual funds. We have a term policy for both of us. I am not the earning member. It's my husband only, and he's in IT. So I'm 42 now, and I know it's pretty delayed, and I should be doing something, and I should check this, the immediate effect. The help which I need is I want a suggestion, a structure to be drawn towards this thing. This is what I have invested in. I have stocks wherein I have invested quite a bit of it, almost 25 lakhs is invested in that. And mutual funds, I have around 10 in that. There's a term policy. Other than that, there's just a house we have.
Uma, I'm going to interrupt you there. I have a couple of questions for you before we go any further. First of all, I want to congratulate both you and your husband for taking steps really to manage your money. And I think it's very commendable that you are managing the household finances. I'm sure you'll do a fantastic job with the household finances. Also, your age, it's not late to start. So I don't want you to be worried about the fact that you're starting late or, that you are not really sure. Don't worry about any of that. We're here to help you out. So it's great that you've started at this point. Now, my first question to you is, does the family have health insurance? Do all of you have health insurance covers?
No, this is another concern area of me. We don't have a health insurance, and I need help in, knowing some names which I can start off as of now. And also my in-laws who are 65 plus, who also need a medical insurance, though they are retired army, he's an army officer, retired army officer. They do get it from their army, but we wanted a private medical insurance also for them.
All right. Do you have emergency money stashed aside for your family, maybe 6 months worth of expenses in a separate bank account?
Yes, I do. It lies in the bank account per se. Otherwise, I put it in liquid funds because 24 hours is good enough. We can always withdraw it. So I always put it in liquid funds that way.
Okay. Narendra, here's a very, very good example. Liquid fund being used for emergency funds, so that's fine. She obviously needs to buy health insurance. Would you recommend health insurance for her in-laws as well, given the services background and the fact that they have insurance from the services? Is it important for all families listening right now who have senior citizens as part of the family who depend on them to buy separate insurance policies for senior citizens?
Yes, of a limited scale, because don't spend too much money, but for the essential scale, because that can derail their savings plan or their current state, because critical illness or something which requires long-term care that can well be taken care of care at the base hospital, for which they'll be entitled to. But of a limited scale, a family floater for the old couple should be bought separately, so that just in case some medical care is needed. Something like 2 to 5 lakh range, which can take care of the essential, or private hospitalization can be taken care of.
So just to put that advice in a nutshell, get a separate insurance plan, a senior citizens insurance plan for your in-laws, but not a very high ticket one. For yourself, for your husband and for your children, of course, try and go as high as possible. Now tell us, you said you have 25 lakh rupees in equity, 10 lakh rupees in mutual funds, and you own a home. How did you start off making these investments? How long have you been holding on to these investments for?
The stocks I started off around 5 years back, and I do a little bit of buying and trading part of it. So that's how I've been building last 5 years. Mutual funds is the same, and this all stocks, mutual funds, and liquid funds, all three of them from last 5, 6 years. That's about it, not more than that.
What about your mutual fund portfolio? Can you tell us what funds you're holding?
I have Franklin India Prima Fund, which is growth, and HDFC Mid-Cap Opportunity Fund, Quantum Long-Term Equity Fund, that's again growth, Reliance Small Cap Fund, growth again, UTI Transportation and Logistics Fund is one which I have taken. And now I see that this is taking a hit, and it's not doing very well, the UTI Transportation and Logistics Fund. So buy more.
Uma, are all of your mutual funds SIP investments, or are you making any sort of lump sum allocations as well?
These are all lump sum. I have, except the Reliance thing, which was for 2 years. It was a SIP, and the rest of it all have been lump sum funds.
Faye, I'm very curious to know one more thing, that 10 lakh that has been accumulated, invested in mutual fund, and 25 lakh into stocks. How have you gone about choosing those stocks?
It's an accumulation of frequent trading, I can say that.
Stop your trading and stop making lump sum investment. Maybe these 35 lakh rupees which you have accumulated, maybe consider 3-4 funds, move this money methodically into that fund portfolio. And for the stock portfolio, it's very exciting. It's very difficult to ignore it. And so I would say that create your small portfolio. Define 5 lakh rupee as something where you'll follow those principles, because if you don't follow your rules, I don't think trading in itself is, it's not, we don't invest money for excitement or because it's interesting. And you want to take care of, serious goals are based on this. So try your hand on that, and don't be in a hurry to invest your money in stock. Understand the company, look for a great company, define your own reasons, and buy them when they are available cheap.
Her long-term portfolio on mutual funds, it did seem like she's picked a lot of funds that you recommend on this show, except for that one thematic transport fund, the UTI Transport Fund. Would you recommend she exits that fund?
Yes, I would say that one exit that fund, and the remaining portfolio one should be investing regularly. One should never be investing at one go, because that will not optimize your return.
Uma, I'm going to put into a nutshell all of the advice you're getting. First of all, buy a senior citizens plan for your retired in-laws, a small amount. Buy a large plan for yourself, your husband, and your children. do not trade in stocks, especially for such a large portion of your portfolio that you're trading in. It's the reason why you're so unhappy with those gains. So Narendra is saying if you really must, if it's something that you really enjoy doing, give yourself a smaller allocation, maybe 5 lakh rupees or less, where you test out your theories and see what turns out. The rest of it should all be moved to mutual funds. Now, the mutual funds, use only SIPs. Do not put lump sum investments in your mutual funds. Do not trade your mutual funds either. Most of your fund selections are fine. Avoid the thematic funds, those specific funds that focus on a specific theme. That's when you lock yourself into a corner in the market, and when that theme turns into a bad cycle, you'll start to lose money. The rest of your funds seem okay. And of course, we are right here, and we're going to be here to help you with anything you need. Quick break on the show, but our email ID is at the bottom of your screen. If you have a question for us, just like Uma does, feel free to get in touch on our email ID. Welcome back. You're watching Investors Guide on ET. Now, this is our Women's Day special. What we're doing is we're trying to help as many women as we can in half an hour by answering as many questions as we can. Narendra Kumar is still with me, helping us answer all of those questions. Narendra, I'm told Anjali Rathore has called us. Anjali, go ahead. Tell us what your question is.
I'm working in the Philippines since the last 2 years, but I have not changed my status to non-resident as yet.
Okay.
I keep transferring money from my NRE account to my savings bank account because my SIPs are going from there.
Okay.
And if I change to NRO, they tell me that I have to first change my KYC details, and I don't want any hassle in that.
Okay.
I'm currently paying 30% tax in the Philippines. So my question is, do I have to continue filing my returns here? And also the money which I transfer from my NRE account to my savings account, does that become my taxable income for this financial year?
All right. Let me bring in Narendra Kumar. Narendra, obviously someone who's moved overseas right now must declare their new status to their mutual fund companies and also to the income tax department. So is it of paramount importance that she makes this change as soon as possible?
Yes, it will be worthwhile to make this change as soon as possible. And because this money coming into the domestic account might be subject to all kind of confusion with the tax department, because they'll be looking at this income flowing into this savings account, and your money, your income in Philippines is also taxed, and giving it and of course the investment that you are making, if they are equity fund, then it will not be subject to taxation, but still clearing things and keeping it straight as needed, or as logical, even if it amounts to getting your getting yourself re-KYC'd, is important.
So Anjali, obviously the advice that we would give you right now is to sit down with a tax consultant as soon as possible and go through all of these various procedures, because it is extremely important that you get this done as soon as possible. And if you're in the country for a little while, it might make sense to do it right now. KYC is not as painful as you think it might be, so you needn't avoid the process because of the KYC, but do this as soon as possible, because transferring money from your NRE account to your savings bank account and then from there to your SIP, that could cause a few complications. We'll also sit down with a couple of our tax experts and try and find the answer for you. Narendra, I'm told we have another woman investor on the phone line, Jay Lakshmi. So Narendra Kumar, who answers all the questions and gives us all the suggestions, is also on the show right now. So go ahead, tell us how we can help you today, Jay Lakshmi.
So as already mentioned, my son's education, and I'm also looking, I have a plot and I'm saving some amount to have a construction done.
Okay.
The house. So currently, I just read out the portfolios, SIPs currently that I'm holding. So I just want to know, and I also hold around 3 scripts on the equity. Smaller number though, but then I want suggestions on those as well. The first one that I have is Birla Sun Life Frontline Equity Fund, and I'm holding this right from 2013. And the next one is Franklin India Prima Plus. That I had another Franklin fund. Sorry, I don't have the name out here now, and I switched over to this just last year.
Okay.
And the next one is ICICI Prudential Focused Blue Chip Equity Fund.
Okay.
And that also very recently, I bought it and I started last year. And then I had UTI opportunities which I had to give off this year because it was on the trading side. And the last one which I hold is one tax saving fund, which is the Axis Long-Term Equity Fund.
Okay. So I just want to ask you a couple of questions.
Sure.
How did you get started investing in mutual funds? Because you've picked a great list of funds right now. And tell us what your target is. So when you want to start construction on that plot of land that you have, when would you like to do this? And how much money would you like to have saved by then?
At least I would like to have a surplus, a collection of around 20 lakhs. And the remaining, of course, I'll opt for a loan. So I'm looking for at least 20 lakhs of saving.
By when, Jayalakshmi? What's your time?
2 years. 2 years' time.
Okay. And the rest of the money is for your son's education and your own retirement?
Exactly. And can I make a mention? Say, firstly, I have a question. Can we just go by the recommendations that are given by the banks with which we hold the demat account? Because I got a suggestion for giving away or selling away UTI, which I was holding from 2013 because it was trailing. So is it advisable to take those recommendations by the fund managers under which we hold our demat accounts?
Okay. So first of all, Narendra, a very interesting line of funds that she has picked, and she's a regular viewer of the show. She's always picked up funds that you recommended. But interesting question there. When the company that she holds the demat account with calls her with recommendations on what she should do with her mutual fund portfolio, should she be taking that advice? Because this is technically not a dedicated, personal finance manager for her. This is somebody sitting in a company who will pick up the phone on a call center and give her recommendations. Would you recommend taking that advice?
Right now, going by the kind of portfolio that you have, which is an excellent portfolio, UTI Opportunity Fund remains a good fund to have. And there was a fund manager change, but I don't think that was the reason why it should have been. I don't think there is any reason why it should have been substituted in your portfolio in the first place. And trailing performance of funds over a brief period of time is nothing unusual. In fact, for any regular investor on a short-term basis, it should not be disappointing. It's just the way of life. That is how it will always be. In a brief period of time, many of your investments might be in negative territory. And that is the time when you should continue investing to optimize your return. Once you have built a good portfolio, be skeptical about any suggestion coming, particularly in terms of changing your portfolio, because that may not be in the best of your interest.
Well, Narendra, if we look at the portfolio she has right now, she has Frontline Equity, Prima Plus, Focus Blue Chip, all great funds, UTI Opportunities and Axis Long-Term Equity. Would you recommend she just continues with these funds and not make any changes at this point?
Absolutely. Make no changes if you have to invest more. In fact, if I have to craft a conservative portfolio with great resilience, I will have these 5 funds somewhat in the same ratio. So if she has to invest more, don't add any more fund.
All right, so that's great advice coming to you right now. Jayalakshmi, you have a great portfolio going. So even if you have to increase, and you will over a period of time increase your allocation or increase your contribution, just stay with the funds that you have. There's no need to make any sort of changes, and don't take advice from random phone calls that you receive. The advice should come from someone you know who is interested in your portfolio, dedicated to your portfolio in some way or the other. Well, that's what we do here on this show. Unfortunately, we've run out of time. We're dedicated to your money and your portfolios. If there are women watching right now and you want us to handle your questions, write to us. We'll spend another week answering questions from our women investors and viewers. Narendra, it's always a pleasure, and I'm really grateful that you spent this time.
Thank you.
Thank you so much. Happy Women's Day to all of our viewers. You're really important to us, and we put you on top priority. Narendra's taken time out to answer your questions. It's right here is where you'll always find space and time on Investors Guide on ET Now. Thanks for watching.